Hey, what's up, stock compounders? Brad here. So today I want to talk about Michael Burry, Dr. Michael Burry. Many of you know him from The Big Short and more recently from The Big Short Squeeze with what happened with GameStop. Now, I didn't know that Michael Burry had put out a one-pager on his investment strategy until I saw this tweet from Brandon Balow. But this is fantastic. He packs so much into one page. I want to go through it, and then I want to take a peek at what he's bought recently and see how consistent he is with his strategy versus what he's actually bought, and if there's any lessons we can glean from that. But before I get there, I want to note, of course, he was made famous through The Big Short. Many of you probably don't know that when Michael Burry was getting started with his fund, he was actually seeded by Joel Greenblatt. There's a website called Value Investors Club. I talk about it a lot. And Michael Burry was submitting investment ideas to Value Investors Club. And at some point, Joel Greenblatt noticed some of these write-ups that Burry was submitting. And as Greenblatt was reading it, he'd think to himself, okay, but what about this? And then Michael Burry would go right to that point. And then Greenblatt would think, okay, but did you consider this? And then Burry would talk about that. So there was this real mind melt in the way that Greenblatt looks at investments and Michael Burry looks at investments. And that's really what prompted Greenblatt to seed Scion Asset Management. So let's get into this one-pager. Let's see, open, see if I can blow it up a little bit here. Strategy. My strategy isn't very complex. I try to buy shares of unpopular companies when they look like roadkill, okay? When nobody else wants to buy them, and sell them when they've been polished up a bit. Management of my portfolio as a whole is just as important to me as stock picking, and if I can do both well, I know I'll be successful, okay? So there's identifying the investment opportunities, the companies to buy. There's also the management of the portfolio, right? When to buy and sell, how to manage diversification and risk and all of that stuff. Weapon of choice is research, okay? Burry loves getting into the weeds on these different companies. It's critical for me to understand a company's value before laying down a dime. I really had no choice in this matter. For when I first happened upon the writings of Ben Graham, I felt as if I was born to play the role of value investor. All my stock picking is 100% based on the concept of margin of safety, as introduced to the world in the book Security Analysis. By now I have my own version of their techniques, but the net is that I want to protect my downside to prevent permanent loss of capital, right? So there's, before anything else, there's this focus on downside protection. We're going to get into that a little bit later in this one-pager. How Burry does that exactly is quite fascinating to me. Specific known catalysts are not necessary. Sheer outrageous value is enough. This reminds me of what Monish Pabrai would always end his Value Investors Club write-ups with. What's the catalyst? Well, a sharp discount between price and value is the catalyst. I care little about the level of the general market and put few restrictions on potential investments, right? So there's all these people trying to figure out what the market is going to do next. Burry, that's in the too hard basket for Burry. They can be large cap, small cap, mid cap, micro cap, tech, non-tech, it doesn't matter. If I can find value, it becomes a candidate for the portfolio. It strikes me as ridiculous to put limits on my possibilities. I have found, however, that in general, the market delights in throwing babies out with the bathwater. So I find out-of-favor industries a particularly fertile ground for best-of-breed shares at steep discounts. And we're going to see stuff that Michael Burry has bought recently is definitely in these out-of-favor industries. How do I determine the discount? I usually focus on free cash flow and enterprise value, market cap minus cash plus debt, basically what you could buy the entire business for. I will screen through large numbers of companies by looking at the enterprise value to EBITDA ratio, though the ratio I am willing to accept tends to vary with the industry and its position in the economic cycle. If a stock passes this loose screen, I'll look harder to determine a more specific price and value for the company. When I do this, I take into account off-balance sheet items and true free cash flow. I tend to ignore price-earnings ratios. Return on equity is deceptive and dangerous. I prefer minimal debt, and I'm careful to adjust book value to a realistic number. So, he's giving a lot of incredible details about how he susses out this discrepancy between price and value with the opportunities he's looking at. Obviously, there's a lot of expertise that come with these things at a company-specific level, right? How do I really get to the true free cash flow and the true value? I also invest in rare birds, asset plays, and to a lesser extent, arbitrage opportunities in companies selling at less than 2/3 of net value, which is net working capital less liabilities. I'll happily mix in the types of companies favored by Warren Buffett, those with a sustainable competitive advantage as demonstrated by long-standing and stable high returns on invested capital if they become available at good prices, okay? Usually they're not, but in the rare time that they are, Burry is happy to buy these better companies that don't fit in the roadkill category. These can include tech companies, if I can understand them. I believe Burry bought Google fairly recently. Maybe it was just options on Google. But again, all these sorts of investments are rare birds. When found, they are deserving of longer holding periods. Okay, so those of you who follow Burry know that his portfolio tends to turn over very quickly. Often from quarter to quarter, you have an entirely different set of names. So it's rare to find those kind of longer term buy and holds for Burry. Beyond stock picking, successful portfolio management transcends stock picking and requires the answer to several essential questions. What is the optimum number of stocks to hold? When to buy? When to sell? Should one pay attention to diversification among industries and cyclicals versus non-cyclicals? How much should one let tax implications affect investment decision-making? Is low turnover a goal? So many people these days are focused on buying great businesses, holding them forever, riding off into the sunset to really make, to really loosen the tax burden of the portfolio. Have a low turnover goal, right? Fundsmith talks about this. This is kind of the framework that Monish Babrai is shifting to. Obviously, Buffett has had this approach for a while. In large part, this is a skill and personality issue, so there's no need to make excuses if one's choice differs from the general view of what is proper. Okay, so you really got to pick the style that suits your personality and style. There's no optimum. I like to hold 12 to 18 stocks diversified among various depressed industries and tend to be fully invested. This number seems to provide enough room for my best ideas while smoothing out volatility. Not that I feel volatility in any way is related to risk. But you see, I have this heartburn problem and don't need the extra stress. I love how Burry puts that. He's managing other people's money. For those of us who saw the movie The Big Short, we saw how uncomfortable it was for Burry to bet on the collapse of the housing market and for it to take much longer than he would have liked to actually pan out. So one way to deal with that emotional, psychological side of investing is to maybe hold a few more stocks than might be optimal so you can sleep well at night. Tax implications are not a primary concern of mine. I know my portfolio turnover will generally exceed 50% annually, and way back at 20%, the long-term tax benefits of low turnover pretty much disappear. Okay, so obviously Michael Burry has done the math on tax implications. Once you're above a 20% turnover annually, it doesn't really matter whether it's 50% annually, 200% annually. Whether I'm at 50 or 100 or 200% matters little. So I am not afraid to sell when a stock has a quick 40% to 50% pop. Okay. Now this is very different from how a lot of more modern value investors think. It's not the typical framework to take that 40-50% pop, get out, and move it into something else. And this is actually something I really appreciate about Burry. It's a bit contrarian, at least in the value investing circles that I'm a part of. As for when to buy, I mix some bare bones technical analysis into my strategy. A tool held over from my days as a commodities trader. Nothing fancy, but I prefer to buy within 10 to 15% of a 52-week low that has shown itself to offer some price support. This is the point that really jumped out at me from this whole thing. That's the contrarian part of me. And if a stock, other than the rare birds discussed above, breaks to a new low, in most cases, I cut the loss. Okay, this is really how Burry is managing the not lose money priority of his investing framework. If a stock breaks to a new low, kind of breaks through the old low, there's not the price support there. There aren't the buyers there that are going to snap it up when it gets down to that point. So who knows where the next bottom is? So Burry just takes his loss and moves on. That's the practical part. I balance the fact that I am fundamentally turning my back on potentially greater value with the fact that since implementing this rule, I haven't had a single misfortune blow up my entire portfolio. Okay, so that's given me a lot of food for thought, that part at the bottom there. And obviously, if you're looking for things that are within the 10 to 15% of the 52-week low, kind of by definition, that's roadkill, right? These are things that are very much out of favor if they've fallen to those levels. So let's jump real quick into Michael Burry's portfolio and see what he's done recently. So he 4x'd his position in Geo Group, and we're going to talk about these individually in a moment. Just want to give a high level. 23% of the public stocks part of Burry's portfolio is in Geo. Now that's only 15 million. The total fund as of the end of 2021 was approaching 300 million. Okay, so 15 million is only 5% of the entire fund, but it's 23% of publicly traded stocks. So Geo Group, Q-Rate, which you hear a lot about in value circles, he doubled his position in Q3. Core Civic doubled. Aerojet Rocketdyne Holdings doubled his position. When you see 100% here, that doesn't seem right. 100%. Maybe is that a new position? Yeah, because change in number of shares held, 5 million, number of shares held, 5 million. So I guess I'm reading this wrong. This is a 4x from 500,000 to 2 million. But I guess these are new positions. Q-Rate, Core Civic, Aerojet Rocketdyne Holdings. And then Charter Communications down here, just under 5%. Again, of the publicly traded stocks that Burry bought in Q3. So let's dig a little deeper on these. Do they fit this kind of strategy that Burry laid out in that one pager? Geo Group. What is Geo Group? It's one of two for-profit prison operators in the U.S. Okay, And it just so happens Burry owns the other for-profit prison operator in the U.S., Core Civic. You could see why those might be out of favor, right? If you're an ESG-based fund manager, which obviously ESG has gotten more and more attention over the years, these are probably some of the first companies you're cutting out of the portfolio, right? Prison operators. So you've got those two in depressed industries. You've got Qurate Retail, which is basically the QVC network, right? Televised home shopping. A lot of investors think, that's, what do they call it here? A melting ice cube, okay? This investor on the Value Investors Club sees it a little bit differently. Obviously, Burry sees it a little bit differently as well. But I want to show you guys real quick what's happened to the price of Qurate and why I think Burry probably got out. Okay, based on if the stock hits a new low, he's not sticking around to see how low that thing goes. So you can see here, Burry bought sometime in this range between $4 and maybe $2.10. Okay, sometime in Q3, maybe between $4 and $2. The price recently broke down to $1.50. Okay, so I'm pretty sure Burry had a stop loss on Qurate. He got out when that thing hit a new low. So that was interesting. We'll see if that's true based on his next 13F filing in less than a month from now. I already mentioned Core Civic, the other for-profit prison operator, Aerojet Rocketdyne, okay, a company that manufactures missiles. You can pretty much guarantee an ESG fund is probably going to drop this. It's probably going to be pretty high on their list of companies to get out of the fund, being involved in the war effort. I will note this company, it was just announced that it will be acquired for $58 a share. So I'm guessing Burry was probably buying in the $40 per share range. So, it's a pretty good pop, maybe a 40% pop, just on that news that it was becoming acquired. And this EV to EBITDA column, this is currently, okay? Back when Burry bought this, it was probably more like 9 or 10x with the EV to EBITDA. So it's a little misleading, this figure. It doesn't represent where it was when Burry got in. Lastly, Charter Communications. I pay Charter monthly for my internet service. So it seems like it has a pretty good moat. Obviously, very capital intensive business. I think that's probably driving a lot of investors away from it. Cable and internet service provider. I also will note one of the investors I follow, Brian Lawrence of Oak Cliff Capital, owns this company. He only owns like 8 or so companies in the portfolio. And in a talk not that long ago, I think sometime last year, he was interviewed maybe on the Investors podcast. And he talked a bit about his thesis behind Charter Communications. So you might take a look at that if you're interested in this one. And again, Scion, about $300 million in assets under management. And I just put that there because, that can have an impact on, what kind of market cap restrictions different investors have in terms of, if it's a really big fund and you want to put a 5 to 10% position on, the company has to be a certain size to be able to do that. So probably for Burry, if he has 300 million assets under management and he's looking for 12 to 18 stocks, the company's probably going to have to be 200 million in size for Burry to get a $20 million position at like a 7% bet, something like that. So, it's a useful guidepost. But let's look at did he follow these the strategy, the kind of guidelines in the strategy? So a few of those guidelines revolve around market cap. He basically said, I don't pay attention to market cap. Why would I limit myself? But is there an area that he tends to fall in terms of when he buys a company? Is it typically a certain size? Well, it does fall within a fairly narrow band, especially these more higher conviction bets here. So small cap is usually considered 300 million to 2 billion, somewhere in that range. The top four are basically within that. Again, this is the current market cap for Aerojet Rocketdyne. When he bought, it was closer to 2.5 billion, maybe 3 billion. So not quite a small cap, but not far from it. So these top four were all in the small cap territory, lower end of mid cap for Aerojet Rocketdyne. So that's interesting, okay? Charter, of course, being the large cap, but again, a smaller allocation into Charter. EV to EBITDA, again, Burry runs this as a screener to kind of initially generate ideas. EV to EBITDA, they were all kind of within the 4 to 10x range. So that could be a useful screen if you're looking to reverse engineer how Burry finds ideas. You might look in that 4x to 10x EV to EBITDA range. Net debt. What did he say about debt? He said, I prefer minimal debt. Okay? Well, that doesn't show up here, at least in what he bought in Q3. Maybe there just weren't opportunities. And the companies with high debt were really hammered in terms of price. And that's what provided the opportunity where Burry saw, okay, it has high debt. I don't like that. But the cheapness of it more than compensates for how much debt it has. So you can see here, Geo Group, $2 billion in debt, $1.4 billion in market cap. Okay, so quite a bit of debt. For Geo Group, Qurate, a lot more, almost 10x debt as compared to equity. So lots of debt there. And that could be what's driving the price through the floor, is concern about that debt. Core Civic, not too much debt, right? It's certainly a lot lower than these first two bets, a little bit less than the equity. Aerojet Rocketdyne, effectively no debt. And again, that company is being acquired at $58 a share. Charter Communications, again, quite a bit of debt, significantly more debt than equity. So that's just kind of a whirlwind tour of my thoughts after reading Michael Burry's investment approach. And the cool thing is, all 5 of these have fairly recent write-ups in Value Investors Club. So you can go in and really try to understand what Burry is seeing in each of these ideas by looking at what other smart investors have seen in these companies. So that's a very worthwhile exercise. Is there anything else I wanted to point out? I don't think so, guys. Oh, one thing I am doing, I've been running these screens, kind of using some of these guideposts that Michael Burry uses. A particularly interesting one to me is it within 10 to 15% of that 52-week low? Now, the frustrating thing, I can't run that screen in Ticker. Ticker doesn't have any way to screen based on how far it is from its 52-week low. You can do that in Value Line. So what I had to do was run a screen, an EV to EBITDA screen using Ticker. And then I ran kind of percent change from 52-week low screen in Value Line. I put both of those in a spreadsheet and I searched for the duplicates okay, where it satisfied both criteria, being between 4x and 10x on an EV to EBITDA basis, and within 20% of the 52-week low. So I can pull the companies that meet both of those criteria and kind of go a little bit deeper on those based on what industries might be depressed at the moment. Well, all of those companies are going to be depressed because they're within that kind of shooting distance of the 52-week low. But anyway, guys, just wanted to dump this on you, that my whole kind of rabbit hole that I went down with Michael Burry's investing approach. Curious to hear from you what you think of this approach, if anything jumped out at you as insightful, anything you might try to incorporate into your own process. Obviously, it's not for everyone, but as a value investor, this idea of searching for roadkill and selling it when it's polished up a little bit kind of resonates on some level. So I may do some experiments along these lines, some kind of test baskets with a portfolio, maybe a Burry test portfolio to try to see how this shakes out. But I will leave you guys with that. Thank you for watching, and see you all in the next one. Take care.